Thank you, Hannes, and guten Tag. You can see 7 months into the role, my German's already fluent. No, but seriously, before I expose my numerous shortcomings with the German language, let me move to talking about the German business. So it's my pleasure and honor to spend the next 45 minutes talking to you about where the German business is right now and where we're going. So without further ado, let me jump right into it. So where is the German business right now? I think the German business is in a really solid, good place. We've delivered reliable, predictable financials on the back of solid operations. And through this, and all of this, despite the fact that we've gone through a fairly large transformation, one of the biggest that I think any of the incumbents in Europe has gone through, the IP transformation, which gave us its own headwinds. And I'll talk in more detail about that. But where we are is a really solid foundation, a place that delivers solid financial results, a great experience, a really good brand, and a solid operation. Question is, where do we go from here? Now, this is a question I've been asked often within the organization over the last 7 months, and often in German. And so that leads to one of my favorite German words, Beschleunigung, by which we mean acceleration. And so the vision really for the next 4 years is to take the solid foundation and accelerate from there. What does acceleration mean? Accelerate in terms of building out the networks for the future, accelerate in terms of our revenue across consumer and B2B, but also accelerate in terms of our internal digitization, so that the combination of all of that creates an acceleration of EBITDA that self-funds the fiber rollout. And last but not least, use all of that accelerated EBITDA, allocate capital well, so that it's not just EBITDA, but also return on capital employed that accelerates. So it's a story of acceleration built on a solid foundation, which you can see has a lot in parallel with the way Tim was laying out the story for the group as a whole. So let me now dive in a bit into our performance and the solid foundation that I talked about. I'll start with just reflecting on some of the commitments we made in our last Capital Markets Day and how we've performed against those commitments. Now, the commitments were 2017 to 21, and the numbers you can see here are our actual reported numbers from 17 to 20. So as I talk through each of them, I'll also give you a flavor of how 21 is turning out. Let's start at the top with mobile service revenue. We committed to a 2% mobile service revenue growth. Our actuals 2017 to 2020 were 1.4%. When you take out the corona effect, it was actually about 2%. And as we look at 21, we're pretty comfortable giving us a tick on mobile service revenue. Let's talk about fixed service revenue. Here, our landmark strategic decision of actually going down the route of vectoring changed the game for us on broadband. So on broadband, we had committed a 4%, 3 to 4% growth. Now the reality is we're storming ahead of that. 4.6% delivered till 2020. Quarter 1, 2021, 6.4% broadband growth. So clearly vectoring is paying off in spades. If you look at our EBITDA commitment, we said 2% EBITDA growth. We've delivered 1.9% 2017 to 2020. That despite the headwinds from the IP migration, and I'll talk about them in a little more detail on the next slide. And 2020 itself also had the COVID headwinds. So our 2020 EBITDA growth rate was only 1.4%, which brought down our overall growth rate in this period. But when you look at Q1 2021, with a lot of the headwinds behind us and some of the headwinds of IP migration turning into tailwinds, you can see the acceleration. We grew at 3.4% in quarter 1, 2021. Cash, the last of those numbers, we said 4 to 5% growth. We've clearly nailed that at 4.8%. So financially, stable, predictable delivery. Let me talk a bit about IP migration, because I mentioned it earlier. Look, we are the only scale incumbent in Europe who's really completed the IP migration. This was a tough journey. What did the IP migration involve? Essentially, swapping out all our legacy infrastructure to put in an all IP network. Especially with B2B customers, this was also the effective equivalent of cleaning up your back book. Now, we started in 2014, but it really peaked in terms of impact in 2018 and 2019. So in 2018, we had 700,000 line losses. 2019, 800,000. 2020, 200,000. 2021, an even lower run rate. The drag of this on revenue was about 100 million a year in 18 and 19. It's about 0.5%. Now, it went away largely in 20. You didn't see it in our results because COVID hit us at the same point. But when you start looking at 2021, you are beginning to see the release of that and the tailwinds coming in. So our service revenue, Q1 2021, grew by 1.7%. Now, the IP migration didn't have headwinds and effects just on revenue. It impacted cost as well. So installations peak because you've got to physically go there and change out the legacy network. Our installations are now down 30% from peak. And last but not least, and this I think will be the most telling factor for the future, the IP migration gave us the ability, and I think we're the only incumbent in Europe who has this ability now, to really build modern, technologically sophisticated products such as SDX, enterprise cloud communication, on top of our all IP network for our B2B customers. So solid financial delivery in the face of a tough IP migration. How have we achieved all of this? I think the core of a lot of this has been operational excellence. If you look at the chart here, we have seen complaints go down by 66%, a 20+% increase in first contact resolution. That's impressive. IT time to market going down from 18 months to 3 months. Add to that the fact that, and I've now worked in several incumbents, our IT infrastructure is amongst the most stable that I've seen amongst incumbents. What's the payoff of a lot of this? Record levels of customer satisfaction and record lows on churn. Further testament to our strategy of invest in the network, invest in service, good things will happen. And that's not just us saying it. You can see we won most of the awards possible in this space. So solid financials, tough migration handled well, delivery despite that, based on solid operational foundations. I'm going to close off the looking back with a quick sense of our other commitments, specifically the ones I didn't touch on earlier. I'd like to start by highlighting cost. It's a bit of a myth here that you can't take cost out in Germany. We reduced 1 billion in cost across GHS and Telekom Deutschland. We reduced our workforce by about 10,000 people between 2017 and 2020. So you can take cost out, you can drive efficiency in Germany. I then want to spend a few minutes on the ambers. So B2B growth, we said 500 million, we delivered 110. Correcting for Corona, we had about a 240 million impact of Corona, which was mostly lost roaming, as well as the big IT deals. We delivered 350 million. And I can always stand here and say, yes, IP migration was the rest of it. But cold, hard facts, I think we would have liked to have delivered more on B2B growth. And we'll talk about our plans going forward. The second area of amber I want to spend a few minutes on is fiber rollout. We said we would get to a run rate of 2 million homes per annum. Last year, we delivered 600,000. This year, upwards of 1.2 million. But in the last quarter of this year, we will be running at close to 500,000 homes per annum. 500,000 homes in the quarter, which is about 2 million homes per annum. So we'll get there. But truth be told, we would have loved to have got there a little quicker. And the last area of amber is then our revenue delivery, where we said we would deliver 1% in growth. Reality, we've delivered flat revenue. Now, some of that is because of Corona. Without Corona, it would have been 0.4%. But I think the more important piece, which is same point Tim made, when you look at service revenue, we actually delivered 0.7%. We chose to let go of some of the lower margin revenue, but still a near miss, so an amber rather than a green. So that's the scorecard and the state of the past, a really solid foundation. Let's now start talking about Beschleunigung, or acceleration. I'm going to skip through the first slide on this. This is the slide Tim talked about in terms of the priorities. Our priorities are consistent with the group priorities. Let me dive into the heart of it and talk about acceleration on the network side. So network acceleration. Where are we on 5G first? As Tim said as well, we today have 80% coverage on 5G. Now, this blows my mind a bit. I've been in the industry a while. It's rare that you find a case where, with a new technology being introduced, one player has twice as much coverage than the next competitor. And the task going forward from an acceleration perspective is how do we now really get efficient about 5G deployment, and more importantly, how do we monetize it? Let's talk about the fixed line infrastructure. I think what was strategically brilliant was the choice to go down the route of vectoring. Now, what has vectoring given us? Several things. We now cover 83% of the country with vectoring and super vectoring. Our choice of going broad and high speed versus narrow and gigabit really paid off over the corona crisis, because we could, almost overnight, allow the entire country to start moving to working from home. The other big advantage of vectoring is in the fiber rollout. Now, our last mile in Germany is shorter than anywhere else in Europe because of the depth of our vectoring coverage. So the last mile in Germany is 200 to 400 meters. That's a lot shorter than elsewhere. We'll come back to why it's still so expensive to roll out fiber, but the length of the last mile, the shortening of that length was a huge achievement of vectoring. As a result, we have a copper network that can deliver up to 250 Mbps, and for a large number of customers already delivers more than 100 Mbps. That's different from a lot of places in Europe. So how do we build on that foundation and accelerate? Let's start with fiber and how we accelerate. Now, I already talked about this at our Q4 earnings call, where we laid out our target of 10 million homes by 2024, with getting to, with our competitors, 100% fiberization of Germany by 2030. Now, since then, I've spoken to a lot of you, and typically there are three questions. The first one, I think Andrew was kind of subtle in the way he phrased it, but how do you know 10 million homes is enough? Is there another CapEx warning coming around the corner? The second one I've dealt with is, tell me more about your fiber strategy. How do you decide where to roll out? What's your strategy? And the third one typically is, how do the economics of fiber work? How does this contribute to monetization? So let me deal with them one by one. Let's start with, is 10 million homes the right number? We are convinced 10 million homes is the right number because we believe that's the number we need to get to above 60% infrastructure share. What drives that conviction? Three pieces. Firstly, the demand side. Now, I've seen fiber roll out in over 10 countries now. Consumer behavior remains quite clear. There are two principles. One, most consumers hate having to move infrastructure and change their in-house wiring and everything else, unless that's the only way they can get high speed. Second, most consumers upgrade the speed of their line one step at a time, at most 2 steps. So they go from 16 Mbps to 50, 50 to 100, 100 to 250, 250 to a gig. Why do they upgrade 1 or 2 steps at a time? Because each step normally comes with a 15% price premium. Now, you take those 2 principles, and all the data I've seen in Germany suggests that those 2 principles still hold. Now, you add a couple of facts to those principles. One, over 80% of Germany has vectoring available. You take a second fact, which is that in our retail plus wholesale 25 million customer base, 80% of customers are at least 1 or 2 steps away from the peak speed that their line can deliver. What does all of that mean? For the next 4 to 5 years at least, a lot of the demand for fiber will come from the 20% non-vectored areas and the 20% in-vectored areas who have already reached the maximum speed potential of their line, which means there will be demand, but that demand will be focused in certain pockets, and that demand will grow, because what will end up happening is that more and more people will reach the peak potential of their line speed. But it will grow steadily there isn't a flood of fiber. There's a steady, nice growth in demand for fiber. And when we work through the math of all that, we come to the answer of 10 million lines will comfortably put us in a place of 60% infrastructure share, assuming people build in economically sensible manners to drive demand. There's a second factor which convinces me that 10 million is the right number, which is supply-side dynamics, and Tim referred to this. Germany, it's bloody hard to build out fiber. You have 2,700 different municipalities, and there's my favorite German phrase now, Genehmigungsverfahren, which is the process by which you get permission to build. That has to be negotiated with every single municipality at a local level. And by the way, the municipality doesn't necessarily always give you permission to do micro-trenching. In most cases, not. Almost never gives you permission to do overhead. What you get permission for is Tiefbau, which is expensive and takes time. So it takes time to scale fiber in Germany. Now, you add to that the fact that construction capacity is pretty limited, and scaling fiber in Germany is a lot harder than what I call fiber to the press release. So there are a lot of people doing press releases on the amount of money they've raised and the rest of it. It's bloody hard doing that with 2,700 municipalities. We'll come back and talk about some unique advantages we have in that context. I think that supply-side constraint also makes me really comfortable that when we scale this machine to 2.5 million households, we will get 60% infrastructure share. Last but not least, every good plan has to have contingency to it. Now, our plan has flexibility, firstly because it's self-funded, but there's an important element of breathing room that we think is critical, which is external funding. Now, what do I mean by external funding? I mean raising external funds in a manner that we get as close to owner economics as possible, and raising external funds with a JV with as much independence that allows us to get off-balance treatment. What does that look like? Think KPN APG. We really like that model. Now, we're in quite progressed conversations on getting there, and that will come on top and give us capacity on top of the build-out we're just talking about. So hopefully that nails question one, why do I believe the 10 million number is right? Let's go to question two, which is how do we think about our strategy for rolling out fiber in Germany? In many ways, it follows exactly the same principles of supply and demand. Now, the way we think about Germany, firstly, is to start de-averaging it. Let's start with the quadrant on the top left here, which is areas where we have an FTTC network and there is fiber competition or coax competition, more likely. This is typically in the large cities, so the Berlins, Hamburgs, et cetera, of the world. And here, also, a lot of customers live in the multi-dwelling units. So how do we decide where we roll out here? How do we actually scale this? We start with the supply side. So the most important thing here is to absolutely make sure that you get the municipalities on site. Berlin, great case in point. We committed to rolling out 1 million households in Berlin because we have a deal with the city where they have made massive improvements in their permission process. They have digitalized a lot of it. That helps take out cost. That helps cut time. We also look at making sure we get agreements with the multi-dwelling units so that we can put our fiber in there. Here, what has been achieved with the removal of Nebenkostenprivileg is massive because it suddenly changes our ability to get into these buildings. Obviously, the other factor we look at here is how utilized are these customers, to what extent do we see demand as people are getting close to top speeds. And again, in a lot of metros, that tends to be quite high depending on the area you're looking at. So that's how we think about the first set. Now, in the first set, these are not just kind of empty concepts. We've evaluated and started now declaring our plans by city. So we declared 1 million in Berlin. We will do 1 million across Frankfurt, Hamburg, and Düsseldorf. And we're now laying out detailed plans per city. Let me now go to the next quadrant, which is the top right. Now, this is areas where we have FTTC, and there is no alternative infrastructure. Now, these areas are very different, and there's a lot of distribution between in these areas, because they range from the outright rural to just outside a city. And therefore, there is a massive deviation in the cost to cover here. So it can range from 900 euros to 5,000 euros in these areas. How do we decide where we go here? What do we do here? Again, the same supply and demand side factors. So let's start at the supply side. Freiburg is a good example. Really good cooperation with the city council helped bring down the cost to build. Other factors we consider here, clearly the most attractive areas in this quadrant are ones with the lowest cost to cover. So we proactively go ahead there so that we can prevent cherry picking. Now, these areas from 2023 onwards will also become available for subsidy, and we'll compete hard and win a lot of subsidies in these areas. Let's talk about the third quadrant here, which is the bottom right, which is kind of really rural. Now, this space, you have no FTTC and no competing infrastructure. It's the center of the government subsidization program. Let me give you some facts here. When you look back from 2013 to today, we have won above 60% of all the households that have been subsidized. In places like Bayern, our win rate's actually 80%. So we like the subsidy program. It's very sensibly structured, and we will continue competing and winning in this space. Now to the bottom left. This is pure market share gain territory, honestly, because here we're in a place where there is competing fiber or coax infrastructure. We don't have FTTC, and our shares are quite often lowest here. How do we attack this space? Again, supply and demand. Good way into supply, partner with the local utility. Example, Glasfaser Nordwest, where we're working with EW Etel to build out here. But there are other options and models as well. The other thing we're looking at is if the costs are low enough and there's high enough utilization here, let's go for it and overbuild, right? And the worst case, or the last resort, is we will hold by and continue to provide our customers with this. So I hope that gives you a sense of how we think about de-averaging the German fiber monster, right? And how we think about going about it. The one thing in common with all of these is the way we approve projects and commit to building. Every project has to deliver greater than the hurdle rate of return, or the hurdle IRR, which is 7.5% 7.5% pre-tax. What that means is our average is not 7.5%. That's the minimum. Our average is clearly north of that. So that gives you some sense of how we think about the different de-averaging of fiber. Let me go to the third question, which was how do we think about economics of fiber? Three big factors driving the economics of fiber: ARPUs, utilization, and CapEx. So obviously a fourth, which is market share gain, which we will have in some areas, but I'm going to focus on these three right now. Let's start with ARPU growth in retail, right? Now, our retail ARPUs have followed the earlier principle I was talking about, which is customers upgrade one step at a time. And as we rolled out more and more vectoring, people moved out from 16 to 50. That's why we saw a 5% ARPU growth from 18 to 20. As we roll out fiber and add to that infrastructure, it will fuel the ARPU growth. On the utilization side, we're sitting today at 51% net add share, which is well ahead of our fair share. We will certainly defend at least 40% net add share in retail. That combination on the retail side fuels the monetization of fiber. On the wholesale side, again, the same two factors. What gives us almost the bedrock of utilization is the long-term wholesale deals we have with our partners, 10-year deals. What drives ARPU is a really forward-looking framework from the BNetzA, which is structured around more for more. And I think Hannes talked about this in detail in the Q1 earnings call in terms of the trajectory and why in 21 and 22 we see a slowdown, and after 23 we see the growth. But the reality here is our new commitment tariffs have a price increase for 50 and 100 Mbps, but more importantly, a clear more for more growth path on fiber. So you pull that all together, the ARPU and the utilization levers across both wholesale and retail drive the revenue side of fiber. Equally importantly, driving down CapEx efficiency. We are committed to reducing our CapEx per home passed by 25%. Let me be clear by what I mean by that. That is CapEx per home passed, like-for-like areas. Obviously, our overall CapEx per home passed depends on our mix. So if we roll out more urban, we have lower CapEx per home passed, more rural, higher CapEx per home passed. But on like-for-like basis, we will take it down by 25%. Is that a pipe dream? Not really. Quarter 1, we are already running at about a 5 to 7% efficiency. So we're already beginning to really move the needle so that by the end of the period, we will definitely be at a place of 25% lower CapEx per home passed. What drives this? 4 things drive this, right? Number 1, scale. So that allows us to standardize processes. That creates massive efficiency. Number 2, digitization. Claudia will talk tomorrow about how much we've reduced our time to plan, but digitization across the fiber factory is a very powerful tool, including with things like T-cars, which allow us to map out an area before we go into that and give us a reliable sense of CapEx. Right? The third big factor here is what our scale gives us in terms of committed relationships. So we talked earlier about construction capacity. We have 70% of our construction capacity for 2022 already signed and committed. We have a similar number even for 2023. Why do we have that? Because of scale, because of our willingness to do long-term deals and our willingness to do turnkey construction. Last but not least, my favorite topic again, Genehmigungen verfahren. Right? Now, the beast that getting approvals from in local municipalities is hard. But it's a lot easier when you have 13,000 people who are deeply regional, come from the area, are able to talk the dialect, can work with the local municipalities to actually get us micro-trenching, to get us the local permissions that we need. So that combination of things is why I'm confident about the economics of fiber and about the 25% CapEx reduction. Moving on to the next piece of accelerating our infrastructure, which is 5G. Building on the head start that we have to drive efficiency and to drive monetization. Now, the head start that we have is not just in coverage, but also in total spectrum deployed, and importantly, especially with 5G, number of sites backhauled by fiber. We have a 75% connect rate of our sites to fiber. Now, how do we drive efficiency on top of this? Similar to the way we've actually been really efficient by using DSS as the way of rolling out our fiber, we're now retiring 3G, and we will use a lot of that spectrum for 5G. We're looking at small cell deployments to further increase the efficiency of our 5G. On the monetization side, I think the first couple of years of 5G will be monetizing using B2B. I think there's order of magnitude a low 3-digit million number in terms of the size available as opportunity for us to go after with IoT, with campus networks, and I'll come back and talk about that. On the B2C side, most of the monetization will come from upgrading our customers to higher tariffs. And again, I'll talk about this more on the B2C side. So that was the heart of Network Beschleunigung. I'm going to now move on to talk about our B2C area and what drives acceleration within our consumer business. Let's start from where we are. Where are we today? A really strong consumer business that gets its strength from product leadership in each individual area. So we're clearly product leaders in mobile, fixed, and convergence. And we have a really powerful brand that pulls it all together. Where do we go from here? How do we build on top of this? I think the next part of this journey, very similar to Tim's articulation of being experience-led, where we think we can unlock growth from here in is from going from product leadership to really growth driven by loyalty and owning the household experience. What does that mean? What does that look and feel like? So starting off with how we create growth from our existing customer base. I've already talked about the fixed line side and the amount of upside left in monetizing our base. 25% of our retail customer base today is sitting on greater than 100 Mbps. There is a huge opportunity as the demand for speed goes up for us to monetize this. We will see 100 to 150% increase in the percentage of our customers who are on greater than 100 Mbps. And with 5 euros typically per upgrade, that is a lot of revenue. The second part of our upgrade story is in mobile, where we will see a 50 to 100% increase in the number of our customers on the largest tariffs. Now, how do we do this? We can learn a lot from the playbook in Europe, in the DT European countries, who've successfully driven a more for more, including an accretive ARPU strategy, by really managing channels well rather than by discounting. I'll come back to this theme in a minute when we talk about convergence. But the important thing is this not just gives us more revenue, but you can see with the chart on the left, it gives us significantly happier customers. And that's a big part of creating growth through loyalty. The second part of the playbook for driving growth in consumer is convergence, is really beginning to own the household. Today, we have 11.6 million retail broadband customers. Let's take a finger in the air. That probably means 20 million SIMs in these households. 5 million of them are Magenta. Gives you a sense of the opportunity available for us on convergence. Again, taking a leaf out of the European playbook, we're at about 51% convergence in Europe. Now, how did we get there? Because 4 years ago, we were about 25, 26%. We got there through very, very disciplined execution. We didn't get there through discounting. What does disciplined execution mean? It means every time you walk into a store, every time you make a phone call, every time you use the app, and I know you're an existing broadband customer, a combination of channel incentives, data in the ecosystem, my CRM, allows me to speak to you about the benefits of getting onto a convergent package. That in the heart of it is what unlocks all of the good stuff in convergence, the 50% churn reduction, the higher ARPUs, as well as the higher customer satisfaction. Now, that's very much the first two steps, or as Tim would say, the horizon one of this. Equally important is now binding this together in a true converged product experience. I know Claudia's got a lovely video on this tomorrow, so I'll leave you just with the headlines of this. In the end, we own the three most important and sticky gadgets in a consumer household. The router, which decides where you get coverage, your TV with Magenta TV, and the mobile devices. Now, our vision here is to pull them together in a seamless experience so that you get a genuinely converged product feel. So that gives you some sense of what underlies the B2C growth story, or the B2C acceleration from product leadership to loyalty and household experience-driven growth. I'm going to move on next to B2B. Now, B2B is interesting, right? Because B2B is, I'm sure a lot of you see it as the graveyard for incumbents on growth. Now, fact one, our B2B business has grown. 0.7%, but it has grown in the last 3 to 4 years, which is more than you can say for most. It's grown despite the headwinds. It's 3 significant headwinds. IP migration, 100 million a year. Corona, 240 million. And we went through a difficult process of integrating a 2 billion euro TC business from T-Systems last year. Despite those headwinds and challenges, it's grown. Why? Because of an incredibly strong market position, really good distribution, good service, and a great network. Now, you put that together, and you get what's now a common picture, I'm sure, for you, a solid foundation on the basis of which we can accelerate. One of the biggest forces that's emerging for me in Germany now is the flood we're seeing of businesses beginning to digitize. Things like the European Recovery Fund, with 20% of it allocated to digitization, will only help. But we're seeing, especially post the pandemic, a huge push towards digitization. And there's a unique opportunity for us in B2B to be at the center of this. But rather than me talk about it, I think this video captures a lot of what I'm saying here better than I can. With that, can we play the video, please, on B2B?
German businesses are digitizing more than ever before. From small to big companies, from startups to the public sector, from hotel to schools, they all need a trusted partner who can offer them the whole spectrum of digital solutions. And that's exactly why Telekom is the partner for digitization. With its integrated digital ecosystem, Telekom offers the right solution for all kinds of businesses.
Die Telekom ist für uns ein sehr wichtiger Partner, der nicht nur nach außen Vertrauen schafft bezüglich der Datensicherheit, sondern uns auch aktiv bei allen möglichen Themen wie Hosting, wie Apple-Endgeräten, wie auch Telefonie und auch Vertrieb unterstützt.
Mit dem Eye-Tracker haben wir die Möglichkeit, die Fahrzeuge auch schnell zu orten und der Produktion just in sequence zuzuführen. Dass wir entsprechende Freiräume uns schaffen, nämlich dass wir uns auf unseren Kunden konzentrieren.
Investing in public institutions and schools, we guarantee a fast and stable net with connectivity and hardware in socially relevant sectors.
Also wir haben jetzt 5G im UKW-Campus, weil wir die Latenzzeit von der Diagnose zur Therapie maximal minimieren möchten.
Das Herausragende an unserer Partnerschaft mit der Telekom ist es, dass wir hierbei mit einem global agierenden Partner auf höchstem Professionalitätsniveau arbeiten können, der eine eigene Sicherheitsinfrastruktur schon aufgebaut hat, die wir nutzen können.
To benefit their needs, Telekom values partnership alongside the customer's vision.
Ich glaube, dass wir auch in der Zusammenarbeit mit der Deutschen Telekom hier eine innovative Marktführerschaft erlangt haben, was das Thema Digitalisierung anbelangt.
Seit 2014 arbeiten wir schon eng mit der Telekom zusammen und das gibt uns wirklich ein Gefühl, dass wir gut gerüstet sind für die nächsten Jahre der Digitalisierung. Alles aus einer Hand, rundum eigentlich der beste Partner, den wir uns wünschen können.
With these digital solutions, Deutsche Telekom enables end-to-end digitization for all business customers. Secure, simple, and innovative.
Thank you. I hope that gives you some feel of the speed at which this is moving in Germany and how central we are to making this happen. Now, especially post the IP migration, with our ability to offer services like SD-WAN, right? This does change the game. Now, a bunch of factors for me now convince me that this business is ready to accelerate from 0.7% growth to 2%. Number one was the digitization flood that I just talked about. Number two for me is the fact that the headwinds have turned into tailwinds, certainly with IP migration, and as we're seeing increasingly with Corona. And last but not least, our go-to-market is really powerful now because we're able to take all the telecom services together and offer our customers integrated services from one hand. So that is the story of why we believe in B2B acceleration. Now, having talked about the digitalization of our customers, I want to now talk about our own digitization. Now, we will look to substantially accelerate digitization in the next 3 to 4 years. Now, starting off with the front end, how do we think about digitalization at the front end? Now, at the front end, or customer-facing, I think our strategy is actually really simple. It is bring together the best of digital with the best of the human touch. What does that mean? It means using digital to eliminate as many routine transactions, to eliminate as many faults proactively as possible. Tim already spoke about the 3,000 bots. We're putting in place now a tool called Magenta View, which gives you an overview of your entire relationship and is powered by AI. Tools like these help remove a large number of the routine inquiries, which then allows us to really invest in our people to solve those difficult problems which need a customized solution, which need someone to talk to you. Now, that said, the only way you can do that is incentivizing them right? I often say telcos sometimes are a bit bizarre. They first cause you a problem, and then they pay people to spend less time solving it for you, which is really what paying people based on average handle time really is, right? Now, with our people model, through dramatic digitization, what we can do is really take home the team of experts model that the US has designed and focus on solving customer issues, focus on incentivizing first-time resolution, first contact resolution. This combination of digitalizing the front end as well as combining that with people where we need them most will see a 60% first contact resolution, more than 200 million in savings over the next 4 years, and a growing customer satisfaction. That's sort of the front end story. But our view of digitalization is full stack. it's not just about the front end. The principles of digitization apply across the entire stack. Claudia will talk about that in more detail tomorrow, but it equally applies to the back end, it applies to our IT, and it applies above all to our network through disaggregation, cloudification, and automation. Let me just give you some quick sense of the way we think of the outcomes of this. Really strong outcomes on customer touchpoints, as I talked about earlier, app penetration, e-sales share, digital share. Very strong outcomes on the IT side in terms of a more agile, quick to react IT. And last but not least, at the heart of our business, cloudifying, automating, disaggregating our network. When you pull all of the digitalization stuff together, what's the payoff? Pretty impressive in the next 4 years. We will take out 700 million in indirect cost. Now, a lot of that will come through directly through the digital tools. Some of it will be the knock-on effect of the nature of the organization we will have, a slimmer, smaller organization, but also some real big knock-on indirect cost effects. We will give up about 300,000 square meters of real estate, 50% reduction in real estate because of this whole process. So that's then, we've now covered off the acceleration of the infrastructure build, how we fund that through accelerating revenue on B2B and B2C, and through accelerating digitization. Last but not least is a subject quite close to my heart, which is the place we occupy in German society. We are proud today of being an integral element of the German social fabric. Nothing shows this more than the way we reacted to the corona crisis. Things like 10,000 smartphones being given to old age homes. Things like specific packages for our B2B and SMB customers to enable them to move quickly to home working. This lies at the center of what Deutsche Telekom Germany is. We believe we play a central role in society, and we don't see that as an obligation. We see that as a privilege and something quite special to be. Just as in all the other areas, we're committing to accelerate this as well. How do we do that? Deep involvement in digital education and literacy. 7,000 schools to be covered through FTTH and digitized. Real commitment to the environment. We're already 100% user of renewable energy, and again, Claudia will talk in more detail about this, but we plan to push further on energy efficiency. And even the way we build networks with the community, for the community, not for ourselves. That combination of things we think is an integral part of who we are, a responsible employer, a responsible corporate citizen in Germany. That sort of covers all of the 5 big areas of acceleration. I'll move on now to the outcome of all of this. Right? The combination of driving B2C growth from loyalty and households to being the chosen partner for the rising wave of digitization in B2B, to driving digitization within our own company, and having built a solid foundation which gives us tailwinds now, enables us to accelerate EBITDA growth from the 1.9% you saw to the 2.5% to 3%. When you put together this accelerated EBITDA growth with real discipline around capital allocation and asset management, some examples. As a result of IP migration, next year we will switch off our SDH platform. That will give us 50 million savings in indirect costs. We are now retiring our 3G network. Mobile network, we have 6,000 sites that we will share in white spots across us and Telefonica and Vodafone. That plus all the CapEx efficiencies I've already talked about will result in, as Tim said earlier, a 50% growth in our return on capital employed. So you have a business here which is growing, creating great terminal value with 10 million homes of fiber by 2024, and still creating value each step along the way, not just with ROCE greater than WACC, but with a ROCE that is growing. And that truly is what acceleration means. Sum this up in terms of our midterm ambition. I think this is a repetition of a lot of the stuff we've said. I'll highlight the 500 million higher cash capex. That was exactly what we guided at the end of at the Q4 earnings call. 2.5% to 3% EBITDA growth, which I've talked about, and 10 million FTTH homes passed, 97% 5G coverage, 700 million indirect cost removal. So all in all, a comprehensive Beschleunigung for the German business. Now, as we talk about acceleration and everything that happens with it, none of this is possible without really charging the motor of this company. 60,000 people who come to work every day at Telekom Deutschland need a purpose. They need a reason to accelerate. And that reason and that purpose is Kunden zu Fans machen, turning our customers into fans. That's the reason why we accelerate. Now, what that means is not just a slogan. It's about us really putting our frontline first, the people who are out there serving our customers through all of the pandemic, the people who are out there day and night actually delivering for our customers, because we believe only by putting our frontline first can we put our customers first, and only by doing this can we make the transition not just to acceleration, but from a solid, well-delivering incumbent to an accelerating unincumbent.
Well, thank you, Srini, and that was really inspiring. And we also feel inspired. We think we should turn investors into fans. So that's our next mission here, or we're trying. But the other thing that we really like is Vorsprung durch Beschleunigung. Yeah. So I can see I need to make an organization announcement. As you might have noticed, we are running over a little bit, and so we'll skip the break. And subsequent sessions will move backwards a bit by 10-15 minutes. Apologies for this, but I think it's important we also have a space for Q&A now on Germany. I know it's a business dear to your heart, and we start with Simon. I can see you, Simon, from Barclays.
Hi guys, thanks for taking the question. So on wholesale, you've been able to negotiate these new wholesale contracts with your wholesalers that have a very attractive more for more structure on pricing going forwards, and as customers move to faster speeds, and that means we're going to see wholesale revenue growth after a short-term hit. But if we think about what's happened elsewhere in Europe, we've seen challengers actively try and avoid this cost inflation that this brings by maybe moving to alternative network providers. So I'm just wondering, is there something in the contracts that gives you confidence that this won't happen, and how can you get comfortable that, say, if a wholesaler does get reasonable market share, they won't seek to get some help from, say, private money that's very interested in digital infrastructure? Because you yourself said if you get good penetration in a certain area where you don't have infrastructure, then you'll be more than happy to overbuild. So I'm just wondering how you think those moving parts play out and why you have a lot of confidence on wholesale going forwards. Thank you.
Yeah. Let me respond to thanks for that question, Simon. So a couple of things. One, there are parts of the contract that we can't really talk about, right? But the overall construct does give us a fair degree of reassurance in terms of utilization of the network, right? And it's hard for me to go into more detail than that, but it does give us a fair degree of reassurance on the utilization of the network. That said, will there be parts and geographies where some people will get some share on the wholesale business? Yes, but equally there are large chunks of areas where we don't have share today. So there will be swap sets that will end up happening as a result of effectively an infrastructure reset, right? But there's enough in those to ensure that that there's a floor to the utilization of our fiber network. And I'm already treading into ground that's beyond which is hard to talk about.
Yeah, thank you, Srini. And it's for sure, we feel very good about these contracts, and we went into a lot of detail as much as we possibly can, right, at the earnings call. But and we are guiding today for flat wholesale access
maybe
revenues.
I should just explain that briefly. Yeah. Simon, the reason we're guiding for flat wholesale revenues, despite the kind of more for more structure, is a well-publicized fact that Vodafone is committed to a certain amount of migration of our network to achieve their cable synergies. So effectively, volume goes down, price goes up. That's what creates stability.
Okay, thanks, Simon. Next question is from Josh at Exane. Josh, good to see you.
Hi, guys. Thanks. I had two questions, please. The first is actually just going back to that very helpful quadrant on slide 12 about the different fibre build areas. I understand the kind of cost of rollout and the potential returns in each of those areas may be different, but it'd be great to get a sense of which of these areas you're going to prioritise most in the near term. I mean, in particular, it sounds like this move to counteract cherry picking could be quite important when we think about the phasing of rollout in 2023 onwards. And then the second question is on this turning customers into fans strategy. So you've highlighted that moving to convergence helps, but are there any particularly strong products in your portfolio and also particularly challenge products which you think you need to change the setup on? I think in the past we've talked about the fact that TV might be lagging a bit behind broadband growth. Are there any actual changes to the product structure you're thinking about as you look to achieve this? Thanks.
Good. So let's start with the prioritization, right? Now, if on that slide, it also had the percentages of Germany in each place, right? So you have 55% in quadrant one. Right? You then have 15, 10, 15, 10, 15, I think, in the rest. Now, broadly speaking, our rollout will follow some of those patterns. Now, what have we announced so far? We've said we will build out 3 million households in rural, right? And that's a public commitment, and that will fit into the right-hand side quadrants. That will be a mixture of subsidies, but also it will be counteracting cherry picking. So that's clearly one place. And then because 55% of the population sits in quadrant one, you will see us build out there as well, right? So I think there will be slight differences in our percentage of build out versus the percentage of population, but it's not going to be dramatically different because that gives us enough leeway to deal with the cherry picker issue. Because if you take, the right-hand side quadrant, yes, there's 15% of the population there, but it's really probably half of it which is attractive to build out without subsidy, which could be cherry picked. So you want to go there first, absolutely. And that we're completely committed to. But that doesn't result in 50% of our money being spent there, just because of the way the math lands up working, if that makes sense. I love your second question on product structures. So firstly, on TV, it's actually a product that we really like, and it's been going very well. As we look forward, one of the numbers I didn't put up there is our plan actually involves an increase in our 3P mix. So from about 25, we're looking to move that to 33%, which is more TV attach rate to our existing products. So it's actually something we see accelerating in terms of where we are right now. Let me come back to your other question of product structures and where that plays out. Look, I think some of the issues with an incumbent tend to be when you have backbook issues, right? And the most significant of those tend to be in B2B. I think what I really like about our portfolio right now is IP migration washed out a lot of those effects, which means we can now start competing in some of those places, SD-WAN migration, for example, without this Damocles sword of the backbook necessarily hanging over us all the time. So my sense of where we are on product structures and what you should be expecting is a lot more focus on convergence and a lot more focus on the Magenta brand in consumer. I think we punch below our weight on the Magenta brand in consumer, and you will see a lot more focus on that. Does that help?
Helpful, thank you.
And that's mainly also relative to, let's say, the Kongstar brand or other. So it's not a very necessarily an imperialist statement. Next we have Ulrich. I think Ulrich, we have you on the phone here. Can we?
Yeah, that's right. Thanks very much.
Oh, cool. Okay, go for it.
Appreciate it. Thank you. I have two questions. Second one very short. The first one is the 4% minimum for the broadband revenue growth looks maybe a little bit conservative, considering the MDU opportunity where the changes to the telecoms law means maybe a quarter of households, your competitive situation improves. Is that essentially because you think there's a case for not rocking the boat too much to sort of not disrupt market structure, or what's the background there? My second question is about the 7.5% return hurdle for the project that you mentioned. Is that an all-in number after the loss of the legacy revenues that necessarily comes when you connect the customer to fiber, or how is that calculated? Because it looks fairly high, given that you're essentially replacing infrastructure from one where you have paying customers already. Thank you.
Good. So I enjoy being told that 4% is conservative. Look, we are growing at 6.5 right now. Beyond a point, I am very optimistic about the broadband business. On rocking the boat on market structure? Look, I don't like rocking the boat on market structure in general. Right now, we will gain share where we land up building, but even on the MDUs. In the vast majority of MDUs between wholesale and retail, we have 60% of the customers in an MDU typically are ours. So when I build into an MDU, I'm often building for my own base rather than to necessarily gain share. We will land up gaining share in some places. There are lots of places where there's performance issues with competition, and we will land up gaining share. But the 4% is, like I said, given where we are right now, I think we've benefited massively from vectoring. I think there's been some flight to quality as a result of Corona. So we think it's a sensible number to guide for. And from a market share perspective and a net add share perspective, I think the above 40 still continues to be where we are because we think that's the right thing from a market structure perspective. I think the biggest thing that the MDU access lands up giving us is it frees up consumer choice on TV, but also importantly, prevents people from blocking our entry with fiber. Right? So that's the way I think of it. On the fiber IRR, look, we can do a separate, deeper conversation on the specifics of the model. But let me just put some of the questions of fiber economics into context, right? Because I tend to think of fiber economics in the broader context of us running a business, a lot of which is valuation, is based on the terminal value. Now, you think of yourself today in a decision where you don't roll out fiber. 4 years from now, you have largely a copper network, and you have a business where ROCE is greater than WACC. You think of the alternative. We grow ROCE greater than WACC, so we create value at each point, and we have a business with 10 million fiber homes, which clearly has significantly higher exit trajectory as well as terminal value. And happy to kind of walk you through the mechanics of how we calculate the project IRR and what drives the hurdle return, what's included, how much of it is a do versus don't do case, etc. And we can take that offline and talk through it in more detail.
Thanks, Srini. So that brings us to the next a question, and that will be from Emmett. Emmett, oh, there he is. Wonderful. Good to see you.
Yeah, good to see you.
Put on a white shirt, really cool. Look very smart.
Well, thank you very much. Thank you. Srini was trying to speak, or was speaking some German. I'll throw a bit of German in too. So, ich habe 2 Fragen, or 2 questions, please. And the first question is on your broadband market share and the outlook for that. And if I rewind the clock back to, we say, the Capital Markets Day in 2012, I think that's when you announced your initial VDSL investment. And clearly that was let's be honest, it was quite a defensive move because you were losing a lot of broadband market share at the time to cable. Now, if you fast forward to this year, your broadband speeds are now quite high. You've got vectoring available to 80% of the population. It feels like a little bit more of an offensive move. So with that in mind, is it fair to say that you could look at winning market share off cable, off the wholesalers, as I think the motivation for moving to fiber is perhaps a little bit different this time? And then my second question was on the ARPU uplift as you move customers onto fiber as well. Can you say a few words about your experience as you move customers onto VDSL initially and onto vectoring later, and what the read across is for retail ARPUs as we roll out fiber? Thank you.
Very good. Look, let's deal with the first one. I agree with you. Fiber is a more aggressive move in the sense of not purely because of market share, but in the sense of I could sit here and make the argument that we don't need to do it just now. Now, I believe that's a defensive incumbent argument. I fundamentally disagree with that argument because when I think of this differently. I come back from where customers are going to be, right? The upgrade cycle, like I talked about earlier, the two principles of the upgrade cycle, everyone tries to stay with their infrastructure until they need to move looking for higher speed. Second, people make one upgrade at a time in terms of speed cycles. Now, you could look here and say, 80% of our customers, right, have at least one or two upgrade cycles left. Let's milk that and then go on, right? My perspective on that tends to be different, which is let's get the 80% of them done in the next 2 years and get ready then for the next cycle of investment, which will give us another round of ARPU upgrades. And let's fund that by driving our efficiencies really hard. And by the way, that upgrade cycle will help fund itself as well. So I agree with you on it is not the classic incumbent way of thinking about it, which is milk the asset as much as you can for now. But it's the market share gain, it'll happen when it happens. But the bigger prize here is the growth within our own base. And for sure, we will land up gaining share in some areas, right? But we also need to make sure that it's coherent with the right structure. The ARPU uplift, great question. Look, there's a €5 ARPU uplift typically with each speed up that you move from, right? What we have seen in the vectoring cycle is order of magnitude of 5% ARPU growth, annualized about 2.5%, right? Now, this is where you kind of get into the question of is 4% conservative or not, et cetera, et cetera. I would expect us to see at least the same because what you will land up having is more of a mix of the higher speeds. Here's how the typical pricing works, right? It's €5 an upgrade up to about 250 Mbps. And then it tends to be more like €10 an upgrade because the curve gets sharper. So I'm hopeful of seeing an acceleration in that, but I will plan on seeing the 2.5.
Good. So I think we take two more questions now. And the first one is from George at Citi. George, there he is. Wonderful.
Hi, guys, and thank you for taking my questions. One is a follow-up on some of the comments you've just made around pricing. It's very encouraging to see that your significant fiber investments have been given some returns as part of the wholesale agreements. But I'm guessing some of the other resellers may want to raise prices over time in order to pass through some of this inflation to the customers. So I just want to hear from your side, what do you plan to do in order to maybe give them the room to do that in order to raise ARPUs, not just when migrations happen, but maybe in a bit more active way yourselves? And then the second question is more around capital allocation outside of fiber. So fiber is slow returns, but low depreciation. We can understand the mix when you benchmark with returns on capital employed. But in the previous presentation, Tim also mentioned about cloud native networks, IT. And some of these things are easier to do when you're greenfield than when you have a huge established base and also a legacy of technologies. I'd be interested to hear from your perspective, what are the challenges in your view, and does that mean you depreciate some of your existing assets earlier in order to move into cloud-native solutions before competition?
So let me start with the pricing piece. Look, I think two or three separate perspectives or reactions to it. I tend to think of speed upgrade-driven ARPU increases as healthy, and there's a real danger in fixed line, right? Where sometimes you are the only supplier in a region, and you view that as permission. Sometimes, like cable in parts of Eastern Europe, to have an annual round of price increases. I think that can get dangerous from a pure customer experience perspective, but also from a regulatory perspective. So I have a bias towards growing ARPUs through as people upgrade, right? The way I think about room, and I think a healthy market structure is always worth keeping an eye on. And one of the things I keep a really close eye on is how's our net ad share evolving? Are we making sure that we're at the right mix in terms of net ad share? And that's where I think your really good question on how do you make sure you give people room plays in, because they can ultimately their pricing is their own call. I look at titrating my mix in terms of what is my net ad share, and I think that's appropriate from a healthy market structure perspective. On capital allocation, and especially on new technologies, Claudia will talk a lot about it. Look, I think firstly on the IT side, I think the view that somehow incumbents have a huge disadvantage is increasingly changing, right? As you get into a world where you're able to introduce, for starters, an intermediate layer which is API-based, you're able to start with overcoming a lot of your disadvantages. And then there's so much cloud-native IT available today that you can piece by piece start taking apart your old BSS and OSS to do a 3-year migration. Now, I think the old world of if you are an incumbent, all you have to do is a big bang IT project that costs 3 times as much as you thought and takes 3 times longer. I think we've proven now in several countries that that's a myth. And in Germany as well, we're making the same journey, right? I think your network question, I think there it is harder to swap it out overnight as an incumbent. But I also think, the components of a network cost structure are more complex, and there are several incumbent advantages in it. The amount of spectrum you have, a huge advantage. The amount of towers you have fiberized. Yes, it's easier as a new player to come in and establish a cloud-native core, but the core is a small proportion of the total cost structure, right? And scaling is really hard. I mean, just to give you an example, let's say you have a player in Germany who is building a cloud-native infrastructure. They can build that, but it'll take them 10, 15 years it'll take them 10 years to get to 50% population coverage. And that scale itself does have limitations purely because of the availability of sites, the antenna available on rooftops, et cetera, et cetera. All of that does impact their ability to really attack. For us, on the other hand, as an incumbent, we are in a place where if we started pushing on O-RAN, which we are doing now, and we're looking at lots of options of really scaling O-RAN, in 4 to 5 years, we could have a significant part of our network disaggregated, and we will always have our 30-odd thousand sites, which gives us a scale advantage. So I think there are puts and takes on it.
Excellent. And of course, more on this from Claudia tomorrow. Yeah. And last question, please, is from James. James, good to see you. Go for it.
Yeah. Hi, Hannes. Hi, Srini. So 2 questions from me, please, first. The first one would just be interested to hear a bit more about your targets around B2B growth. And I'm thinking about this specifically in the light of what Vodafone said yesterday. They specifically were talking about increasing their investment in B2B and seeing considerably higher growth rates, maybe heading towards mid-single-digit revenue growth. I mean, is this an opportunity you see where you might actually be able to increase investment more in Germany and potentially drive higher growth than you're targeting at the moment? Or do you see something specific about Germany that maybe the B2B growth rates in this market are going to be a little bit lower? And the second question I had, please, was around the network economics you were talking about in some of these joint fiber projects, and just love to hear a little bit more about how that works. So your projects, for example, with Net Cologne or EWE, as you're migrating customers potentially over onto those shared networks, how are you incentivized to do that if you're moving from 100% ownership of a network to a network that is joint owned? We'd just love to hear a bit more about how you see the economic payback from those models. Thank you.
Good. So let's split three different types of models. James, sorry, I'll deal with your second question first. Three different types of network economics models, right? I think the net cologne one is a pure whole buy, right? And so that's why I said this is my last resort, right? I do lose margin in the process of moving to a whole buy, right? That's now we have whole buy today in FTTC. We will have some whole buy tomorrow in FTTH, but that's not going to be the center of my economic model. AV-ATEL, very different case. That's one of the bottom left quadrants, right? Where we didn't have FTTC, reasonably low shares. There's a lot of upside in creating that model. The third different model is kind of the KPN APG model, right? Which is if we get into a model with an investor. Now there, the way we maintain as close to owner economics as possible is by trying to figure out ways in which we can effectively capture a lot of the value between the passive and the active layer, right? Because when you de-average a network, right? Ideally, when I buy someone else, I want to buy passive, or if I'm buying active, I want to be the provider of the active services that go with it, because I have scale on active, right? That's how I think about making sure I get close to owner economics and gives me incentive to migrate. Or in the AV-ATEL case, there's pure upside, and net cologne, whole buy is whole buy. I will do it, but I have to. But it's not my going in. It's not my going in choice, and I would ideally prefer to do it when I do it with community-based players like AV-ATEL rather than pure overbuilders and cherry pickers. So to your first question, B2B growth. Look, I think there's upside. I think the place. I don't think this is a question of investment in our case, because we're making the investment in fiber and networks and infrastructure. I think the real question here is for us, how do we make sure that we develop cutting-edge B2B product, right? And cutting-edge B2B product, both in terms of software-defined networks, but also things. I mean, Tim's point earlier, being able to manage a disparate, diverse network. And being able to control and automate it, right? That plus areas like cloud communication, right? So I don't think this is network investment. I think this is product investment. We do foresee a fair amount of that. Is there upside to the 2%? Yeah, I'd love for there to be. Right? Am I happy to say right now there is? We'll see. I mean, I think you can bet too much on things like the EU Recovery Fund. I saw a lot of press about that yesterday. If those tailwinds blow in Germany as well, then we will benefit from it more than anyone else.
Excellent. Thank you so much, Srini. And that brings us to the end of this Q&A session. And of course, we'll be talking to you a lot more in the next weeks, months, and years on many of these subjects.